Several of you have been commenting this week on something I said in the last video. You said you had no idea what an expense ratio was. You had no idea your mutual fund was charging you more than 1% every year. And you had no idea that fee was quietly destroying your retirement. Today, we are going to fix that completely. This is the Vault Keeper. Here is a number that should make every American stop what they are doing and pay attention: $170,000. That is the estimated amount the average American household loses over a 30-year investing period by choosing actively managed mutual funds over low-cost index funds. Not from bad stock picks, not from market timing mistakes, simply from paying higher fees on funds that, according to 4 decades of data, do not consistently outperform the cheaper alternative. Let me explain exactly how this works, because understanding it changes how you make every investment decision for the rest of your life. When you invest in a mutual fund, which is what most 401k plans offer as their default option, you're paying a team of professional money managers to pick stocks on your behalf. That team charges an annual fee called an expense ratio. The expense ratio is expressed as a percentage of your total investment. A fund with a 1% expense ratio charges you $1,000 per year on every $100,000 you have invested, every year. Whether the market goes up or down, whether the fund performs well or poorly, the fee is automatic and invisible. It is deducted from your returns before you ever see them. Now here is the question that Wall Street does not want you asking. Do those professional money managers actually earn their fee? Do they consistently outperform a simple index fund that just buys every stock in the market and charges almost nothing? The data is unambiguous. According to S&P Dow Jones Indices' annual SPIVA report, the most comprehensive study of active versus passive fund performance, over a 15-year period, approximately 88% of actively managed U.S. large-cap funds underperformed the S&P 500 index after fees. Not 50%, not 60%, 88%. 9 out of 10 professional stock pickers with entire research teams and decades of experience and access to information the average investor does not have failed to beat a simple index fund over 15 years when fees are taken into account. Why does this happen? Because markets are highly efficient. The price of any given stock already reflects the collective knowledge and expectations of millions of investors around the world. For a professional fund manager to consistently beat the market, they would need to consistently know something that the rest of the market does not know. And by definition, very few people can do that consistently over long periods. The index fund, by contrast, does not try to beat the market. It simply buys the entire market at the lowest possible cost. And because the market as a whole tends to go up over long periods of time, the index fund captures those gains without paying a team of managers to try and fail to improve on them. A Vanguard S&P 500 index fund, one of the most widely available and widely recommended investment vehicles for ordinary Americans, charges an expense ratio of 0.03% per year. That is 3 cents per year on every $100 invested. Compare that to the average actively managed mutual fund charging between 0.5% and 1.5% per year. The difference is 0.47% to 1.47% annually. That gap, compounding silently over 30 years, is where the $170,000 disappears. Let me make this concrete with a specific example. 2 investors each start with $50,000 at age 35 and invest until age 65, 30 years. Both earn the same gross market return of 7% per year before fees. Investor A is in an actively managed fund with a 1% expense ratio. Investor B is in an index fund with a 0.05% expense ratio. At age 65, Investor A has approximately $338,000. Investor B has approximately $380,000. The difference is $42,000 on a $50,000 starting investment just from fees. Now scale that to the average American household with $150,000 in their 401k. The fee difference over 20 years is over $100,000. That money does not go to your retirement. It goes to the fund manager. Now let me tell you the 3 most common fee mistakes American investors make and exactly how to fix each one. The first mistake is holding actively managed funds when identical or superior index funds are available in the same plan. Every 401k plan that complies with federal law is required to offer at least some low-cost options. Most plans include at least one S&P 500 index fund and at least one bond index fund. If you are currently in an actively managed fund and a comparable index fund is available in your plan at a lower expense ratio, switching is almost always the right move. The paperwork takes about 5 minutes and the impact compounds for decades. How to do it? Log into your 401k account, go to investment options, look at the full list of available funds, sort by expense ratio. The lowest expense ratio options are almost certainly index funds. Compare the category, large cap, small cap, international bond to what you currently own. Switch from the high fee version to the low fee version in the same category. Done. The second mistake is paying fees on money market funds or stable value funds for money you intend to keep invested long term. Many Americans hold a portion of their 401k in money market funds or stable value funds because they feel safer. These funds do have lower volatility, but they also have lower long-term returns and often charge fees that eat into those already modest returns. If you are more than 10 years from retirement, money you hold in low-yield stable funds is money that is not compounding at the rate your long-term financial security requires. The third mistake is not knowing what you are paying in total across all of your financial accounts. Most people with a 401k through their employer also have a personal IRA, a taxable brokerage account, a bank savings account, and sometimes an old 401k from a previous employer they never rolled over. Each of those accounts may be charging different fees. The total picture, what you are paying across everything, is often dramatically higher than what any single account statement shows. This is where a tool like Personal Capital becomes genuinely useful. Personal Capital connects to all of your financial accounts in one place: your 401k, your IRA, your bank accounts, your brokerage accounts, and it runs what it calls a fee analyzer, an automatic calculation of every fee you are paying across every account, expressed as an annual dollar amount and a percentage of your total portfolio. It shows you your current fees, it shows you what those fees cost you over 20 years, and it shows you what you could save by switching to lower-cost alternatives. It is completely free to use. The tool does not sell you anything. It just shows you your own financial data in a way that your individual account statements never do. The link to create your free account is in the description below. Now let me address the most common objection I hear when this topic comes up. Some people say their financial advisor recommends higher cost, actively managed funds, and their advisor has their best interests at heart. That may be true, but it is also true that the financial advisory industry has a documented history of recommending higher fee products, in part because those products pay higher commissions to the advisors recommending them. This is called the compensation conflict. It does not mean every financial advisor is acting in bad faith. It means the incentive structure of the industry creates situations where the advisor's financial interest and the client's financial interest are not always aligned. The Department of Labor's fiduciary rule, which has been debated and revised multiple times over the past decade, was specifically designed to address this problem by requiring advisors managing retirement accounts to act in the client's best interest rather than simply recommend suitable products. Understanding that this conflict exists and verifying that the products you hold are genuinely the lowest cost options available for your investment goals is one of the most important financial literacy skills an American investor can develop. The bottom line is simple. You cannot control what the market does. You cannot control inflation. You cannot control what the Federal Reserve decides to do with interest rates. But you can control what you pay in fees. And controlling your fees is one of the highest return, lowest risk actions available to any investor, regardless of market conditions. The $170,000 that the average American household loses to fees over 30 years is not inevitable. It is a choice made by default, without information, in the first week at a new job when nobody explained what an expense ratio was or why it mattered. Today you have that information. The next step is acting on it. Check your expense ratios today. Personal Capital makes it free and takes 5 minutes. Link is in the description. Subscribe to the Vault Keeper newsletter for daily financial intelligence before markets open. Every morning before the session starts, you get the information that matters before anyone else has it. Subscribe. Turn on notifications. Data before price. The Vault Keeper.